And we are on.
Amazing. Good morning, Isabelle. It's so nice to see you. And
Hi,
I just want to
Lindsay.
thank you. Before we start,
Pleasure.
I feel super, super lucky to be having this conversation with you, for you to take the time to really help us kind of understand these new capital gain inclusion rules. Do you want to start by just introducing yourself?
Sure. So thank you so much for having me. It's a pleasure to have this discussion with you today. So my name is Isabelle Nadeau. I am a tax partner at Crowe. We're a mid-size accounting firm, and we're located just across the street from you. So we're neighbors.
And I think it's really awesome to be able to say that we also work together.
We did
And
it in the previous lives.
in a previous life, and Isabelle is a superstar. I was looking at your bio. We both went to McGill. We both did our masters at HEC. You won all kinds of prizes, which don't surprise me. But
Thank you.
you have not ceased to impress. So, again, this is really a great opportunity. So I just recorded a little video where I tried to explain what a capital gain is and high level what the proposed rules are.
Great.
So we don't have to kind of go back into that. But
Perfect.
I
And focus
thought,
maybe more on the planning
yes,
opportunities and what are the pros and cons in implementing different strategies in anticipation of the changes.
exactly. And I
Great.
wondered, before we start, have you heard anything about these rules changing? Because before we get into kind of what to do about them, there
Right.
are rumors or talk about either changing, I think maybe the effective date of June 25th, I don't know, or the actual rules. Have you heard anything about that?
I've heard some rumors, but they're all rumors. So how reliable is this? One thing though that is quite surprising is that the draft legislation implementing the changes has not been released. It can happen that the draft legislation on major tax changes is released later, but for something like this, where the window of opportunity for planning is that short, because let's keep in mind this was announced mid-April. So
Yeah,
we're looking at 2 months and a half ish for planning, which is very, very short. It's surprising that the draft legislation hasn't been published, and that is still true as of today. So it wasn't released with the budget, but it still hasn't been released as of today. Um, so is
and
it?
that would include, sorry to interrupt you, that would
No, go ahead.
include kind of all the related tax rules.
Course. Yeah, because there's a lot of uncertainty. Like in the budget, we had the general lines as to what the measure is going to be. But when you start to look at a strategy for a client more in depth, there can be all kind of individual circumstances where you have different technical questions, and the answers to these questions normally would be in the draft legislation, but it doesn't exist as of today. So to implement planning is challenging because there are certain unknowns at this point. So it's yes, it
That's a
is it
really
is
good point.
challenging. And
Yeah.
also let's say it passes. Okay, fine. Is it going to stay? Because we know when we look at the history of the capital gain inclusion rate that it has changed over time. It has gone up to 75% at a point in time, but it has after that gone back down. So is this a permanent measure? Unfortunately, we'd need a very good crystal ball to find out, which we don't have. But is this something that would stay? We know that on the federal political scene, the government we have now, is it the government we're going to have in 2 years? We don't know. But if we were to have a conservative government, for example, would they keep on with this measure, or would they change all of this back? Uh, that's part of the uncertainty that clients have to keep in mind in deciding to implement strategies that have an immediate tax cost, because we don't know if that tax cost is a good investment or not.
Yeah, it's a really, really good point. So ignoring that, if we're to jump in having to deal with the rules as they were proposed in the
Yes,
2024 budget,
yes.
um, what are what are like what are some of the biggest issues that you're kind of being asked about?
So obviously, the increase in the inclusion is equated to a higher tax on the capital gain, obviously. So the first uh, thought that comes to mind is, should I do something to accelerate the realization of a capital gain?
Exactly.
In order to take advantage of the capital gain rate at 50% right now. I think that's really the main question that clients have at this point. Who should consider doing something and what can be done?
Yes.
So, uh, and one factor that we absolutely need to keep in mind is the application of AMT, alternative minimum tax. So we will talk mainly about capital gains, but I do want to pause here for a second to talk about the new AMT rules because
Please
it's
do.
very important when it comes to individuals trying to crystallize gains at 50% prior to the cutoff date of June 25. So AMT has been around for a number of years, as you know, but it was not a major tax planning priority in the past because it applied to fairly limited circumstances. I think the most frequent situation that I saw, at least in my practice, was when the capital gains exemption was taken advantage of on the sale of certain shares of businesses that meet a
Hmm.
number of conditions. That was an important planning point. But for many other planning strategies, it didn't have any impact because if you were to generate a regular capital gain, let's say on public stocks or on real estate, the alternative minimum tax would not have any impact on that kind of capital gain. What's the AMT? It's a parallel tax calculation that we have to do based on alternative rules. And if the tax calculated based on the AMT rules comes up higher than the regular tax, then you have to pay that highest amount, that AMT
Hmm.
amount, instead of paying the regular tax. The good news about AMT is you can recoup it in the future, but
Yeah.
not everybody is in a position to do that. You need to generate sufficient income, and it depends on the type of income that you're generating also. Um, so you can recoup it, but not always. And in any event, even if you can recoup it, you still have to pay it now. So there's an immediate cash outflow that can be associated to AMT.
Hmm.
So AMT has changed quite drastically on January 1st, 2024. And what the new rules for AMT provide, it's basically an increase in the AMT rate. Um, but it depends on which categories of taxpayers, because based on the AMT calculation, you also have an annual amount of AMT exemption, which used to be quite low, $40,000. Now, under the new rules, it's much higher, 175, which is good, but the rate is also higher.
Right.
So all this to say that, let's leave aside the AMT exemption. Let's say you were over and above the either 40 or the 175. For capital gains prior to the changes, you were looking at an AMT rate around 27-ish%. But it depended on that would be for the sale of QSBC shares, of small business shares. But now the new AMT rate it's much higher. It's 36%.
Mm.
So if you do all kind of income tax planning and you forget about AMT, you could have a very big surprise at the end. So it's really important to keep AMT top of mind when considering any kind of capital gain plan. Because if we look at some tax rates, so right now, assuming the maximum rate for a capital gain, we're at 26.66% in Quebec. And with the new rate, we're going to go to 35.50 or 0.54%. The AMT is 36.12%. So if you say, oh, great, I'm going to crystallize a gain at 26%, but you forget about your AMT, you're gonna come up with a surprise at the end of the day. So that's something that's really important. And AMT is really something that needs to be analyzed on a case by case basis. But it's just really important to have this in mind.
And I
So
think I
yeah,
thank you so much for starting there, because I could have said this at the outset, and I should definitely say this numerous times. Please consult a qualified tax professional for your specific circumstances when thinking about any tax matters, really. But in trying to make decisions about these changes in particular.
yeah, there's nothing that replaces an actual number crunching that's personalized for each person's situation.
Yeah,
So going back to crystallization of gains at 50%, if we leave the EMT aside, but we know we have to calculate it. We know we have to see how it impacts. Um, so crystallizing a gain can be interesting because there's an 8.89% difference between the old rate and the new rate. So
yeah,
that's definitively something attractive. But of course, the flip side of this is the prepayment of tax.
right.
And prepayment of tax means what is the time value of money? And there, the answer again depends for many different people. What kind of return on investment are you looking at, and for how long can you invest the capital? That very much depends for everyone. So there are certain situations where the answer is a little bit clearer. If you're thinking about selling an asset within the next 12-month-ish, you would seem to be a good candidate for crystallization. If you're looking at more than 5 years, probably not. If it's in between, then you're in a more gray zone, depending on personal circumstances. But that is the main consideration, the time value of money, uh, because prepaying tax obviously is not necessarily something we want to do, but it can also result in loss of revenue if at the end of the day we're leaving money on the table because that capital is not working for us anymore because we've paid it in tax dollars.
Exactly.
And sometimes it's also just not possible because if, for example, you're crystallizing a gain, for example, on a real estate property, but you're not very liquid, you're very real estate oriented in your investment strategy, where are you going to find the money to fund this tax liability? So sometimes it's just not even an option.
Hmm.
And sometimes it is, but with a secondary cost. So, for example, let's say you can fund the tax liability, but you have to sell other assets which have also gains on them. Then you have that compounding effect here.
Yeah.
And also a more minor consideration, but again, just to avoid surprises, if you trigger capital gains, it can also impact your eligibility to old age security if that's
Mm.
a social benefit that you can claim because it impacts your taxable income for the year in question. So there are different considerations with this.